In this week's video, we'll review the latest charts and data to help us answer the question, is CPI about to catch many on the wrong side of the market? The video is designed so you can use the pause button on your video player. What's changed over the last 4 trading sessions relative to our competing themes? We covered this topic last week. We had a holiday-shortened week with the markets being closed for Labor Day. We recently covered numerous breadth thrust signals that we know historically had an excellent track record relative to the stock market looking out 1 and 2 years. On the other end of the spectrum, we also covered signals that appeared after Jackson Hole that were extremely concerning and put those breadth thrusts in doubt. The concept of competing themes and conflicting signals may seem a little counterintuitive, but that's just where we are right now. CNBC article dated September 8th. Deutsche Bank sees binary outlook depending on recession. S&P 500 falls to 3,000 or makes new all-time highs. Heading into this week, it was prudent to respect a wide range of scenarios. In last week's closing bullet points, we talked about 3,900 on the S&P 500, covered some things that we would be looking for from a bull-bear perspective relative to a tweet on August 31st and a follow-up tweet on September 1st. Given the market had an extremely adverse reaction to Powell's remarks at Jackson Hole, just as we had on September 2nd, we came into this week with a very detailed contingency plan from a bull-bear perspective. This is the chart that we covered last week. We said the good news was we were still above this upward sloping trend line, and for the most part, we did have that slowing momentum look that we were looking for in advance, and RSI was well above 30. We also noted that the bad news was that you could have made an argument a week ago that we really hadn't even tested this trend line yet. Again, this is dated Friday, September 2nd as of the close. That's a week ago. So how did this chart evolve between Tuesday and Friday of this week? Here's the look on September 2nd. The theory from the prior week that we still may need to test this line turned out to be accurate. You can see price here on the 10-minute chart came down and bumped up against that trend line numerous times, but we did have a good look on Tuesday's session, even though the S&P 500 ended up down 16 points for the day. This is still a favorable look here relative to what we were looking for. So Tuesday's session was somewhat of a nail-biter relative to these important levels. We popped up on Wednesday, September 7th, and then intraday on Friday, September 9th, we were well above that 3,900 reference point. The entire video is being recorded after the close. The early read after the close is that we had a 90% update on Friday, September 9th. We also covered this chart a week ago and said all things being equal, we would prefer to see RSI on the S&P 500's daily chart remain above 36, and maybe more importantly, remain above 30. Came right down into a logical RSI area and thus far have held. RSI on Friday closed just a hair under 51 on the S&P 500's daily chart. You can see the 50-day moving average here still looks pretty constructive. And why is that relevant? Because there have been a lot of rumblings on Wall Street in recent weeks that something was about to break, which is another way of saying something is about to fail, or that we were going to run into some type of liquidity problem. Now, if that were the case, we really wouldn't expect this 50-day moving average to look like this. Because the setup that we had coming into this week was that we were concerned really about something like this horrible plunge here that took place in Q4 of 2008. And you can see price action in here near the same 50-day moving average. This looks a lot worse in here before this waterfall decline. Also, you can see RSI recently on the daily chart was up near 70, and we did hold for the most part the 36 and 30 levels. That's not what we had during this plunge here in 08. We're below RSI 36 in here, and we're below RSI 36 in here. Present day looks better than that. Also noteworthy, price never really retakes that 50-day moving average in here. It's not what we have in the present day. We can also compare and contrast RSI in here when bad things are happening relative to the look of RSI after the low is in. This over here looks more like the present day relative to this look in here. In last week's video, we had a bullet point that said failed breadth thrusts. But in terms of the commentary, we said it's possible we have failed breadth thrusts. We also noted that the bull's margin of error was relatively small, and again that 3,900 was an important short-term reference point. From the September 2nd video, a little bit of an overshoot here and then a nice bounce. This is also starting to flatten out a little bit. Doesn't look as bad as this here. Last week, this week, gap up and a close above an upward sloping 50-day. A lot of concerning looks last week, but we also had some looks telling us to try to be patient. This is the 50-day moving average for the equal weight S&P 500 index. Last week, September 2nd, 50-day up here as well. We would think from a probability perspective, if something was about to break, days away from breaking, that we would be seeing something more like this. So during the week this week, knowing that 3,900 was a relevant level from a short-term perspective, so during the week we're trying to discern, is there any basis for patience near 3,900? Here, the answer is yes on September 6th. Here, the answer is no. So things aren't perfect this week. They're mixed earlier in the week on the 6th. Here's a tweet from the 7th. Breadth looked pretty good intraday. And Fed comments in line with market expectations. And this is a real head turner here. This is September 7th from Sentiment Trader. Sentiment is just overloaded on one side of the boat here. And we know that extreme sentiment can be a contrary indicator. If something were about to fail, or we are about to see a waterfall plunge like this, and that's really what we had the setup for coming into this week, a waterfall additional leg down. We wouldn't expect to see this over here from September 7th, and we really wouldn't expect to see this type of favorable look relative to the prior high in credit spreads. And the present day looked a lot better than where we were year to date in 2008, right before Lehman failed. This is July of this year. This is fear. Fear doesn't look as bad this week. Contrast this with the fact the day Lehman declared bankruptcy, credit spreads made a new high for the year. We're nowhere near a new high earlier this week. Again, from September 7th, this really doesn't align with an imminent waterfall plunge. Compare and contrast the present day to the days leading up to Lehman. This is the Friday before Lehman Brothers declared bankruptcy on the following Monday. This is the 50-day moving average. These are all 50 days over here in 2022. Typically, the most important topic relative to the Fed and interest rates centers around whether Fed expectations and market expectations are aligned. So earlier this year, Q1 of this year, the Fed's talking about raising interest rates, and the market, for the most part, is not on the same page with the Fed. And that's typically when you see increased volatility and big drops. Example, the market was not aligned with the Fed heading into Jackson Hole. We needed to have a little bit of a realignment relative to market expectations. Not so this week. September 8th, another extremely rare reading, lopsided reading, extreme reading relative to bearish sentiment, simply telling us to keep an open mind about better than expected outcomes. These type of reads also tell us to keep an open mind about a waterfall plunge, because sometimes sentiment gets it right in the short run. That's why these intermediate term looks like this are relevant, and we still need to monitor them. An inflection point look here, the equal weight back above an upward sloping 50-day during the session on the 8th. High yield down here, indecisive all over the place. But as of the close on September 8th, we were back above this downward sloping trend line. September 6th, we said this really didn't look good. This morning on September 9th looked a lot better. Why are we monitoring this? We're monitoring this because it helps us understand the market's appetite for risk. Friday morning, we have Fed comments that are still in line with market expectations. We get a very favorable, market favorable comment out of the ECB in Europe relative to stability concerns overseas. All of these occurring this week. Fed expectations in line with market expectations. Fed expectations in line with market expectations. Fed expectations in line with market expectations. When they're out of alignment, that's when we tend to have market dislocations or big moves up or down. That speaks to the possibility that the market has already priced in where the Fed is heading. So the Fed's basically saying early next year we should be somewhere in the vicinity of 4%. That's exactly where market expectations have been this week. Market's pricing in roughly a 95% probability February 1st of next year that rates will be somewhere between 3.75% and 4.5%, in line with this, and this. And even this theory really isn't holding water. Bullard said the markets are underpricing higher for longer. It's kind of difficult to say. CMA looks all the way out to July 26th of 2023. The markets are pricing in a 96% probability that rates will remain at 3.5% or higher, and a 78% probability that they'll fall somewhere between 3.75 and 5%. Those are very, very reasonable probabilities when you consider all of the uncertainty between the present day and July 26th of 2023. I'm not really sure this even holds water, but that's for the market to decide. Similar concepts here. The market pretty much knows, unless something changes, there's a 75 basis point hike coming at the next meeting. Nothing really new here. Will inflation force the Fed to usher in a recession? As we mentioned last week, we have the big CPI report coming just one trading day away now. We've got Monday, and then this is announced before the open on Tuesday, September 13th. It's possible you can read something into that we knew CPI was coming and the markets moved up roughly 100 points in 4 sessions prior to CPI. It's possible. So even with all the concerning looking charts as of last Friday's close, we're still coming into this week respecting that markets are forward-looking mechanisms, meaning they may be looking out and saying that CPI is going to come down in the next 6 months and that we still should respect all scenarios, from wildly bullish to wildly bearish. Another way of asking this is there any reasonable basis to expect CPI to come down? We do have data in hand that tells us there is a reasonable basis to expect CPI to come down, possibly in the second half of the year. Left side of the screen here speaks to sentiment and keeping an open mind about better than expected outcomes. Right side of the screen speaks to differences between the present day and the 1970s and early 1980s. You can compare and contrast the present day here on the right side with the 1972 to 82 window on the left side of your screen. Probably fair to classify this as excellent research, but anecdotal evidence. From an anecdotal perspective, this tells us to keep an open mind about CPI falling in the coming weeks and months. Really doesn't tell us a lot about what to expect next Tuesday. Similar situation here. The longer term outlook, yes, we can expect inflation to come down. There's a basis for that expectation. Shorter term, we'll have to see what happens on Tuesday, not making any assumptions. You can pause your video player here. How about the case for a soft landing, an economic soft landing? And a quick update on a topic we covered a few weeks ago. When we looked at this topic on August 26th, from a data perspective, there really wasn't a high probability to state that the economy had already entered a recession or was currently in a recession. How about these down here, these data points? The 2 most important measures in recent decades. Remember, we compared past periods to the present day. And as of August 26, we said this looks really, really good. We just made a new all-time high just one data point ago. And we have an additional data point now. We just made a new all-time high. That's quite a bit different than the recessionary period caused by inflation in the 1970s, and quite a bit different from what this looked like in the 1973-74 bear market, where the S&P 500 lost approximately 50%. And for the most part, we can draw the same type of a conclusion when we look at non-farm payrolls. When we covered it on August 26th, we had just made a new all-time high relative to the seasonally adjusted data, and we can say the same thing now. We have another data point. It still looks good. This chart here looks nothing like this chart here during the financial crisis bear market and recession. And we've covered this topic in the past. We're basically in the favorable seasonal window relative to midterm elections. A typical midterm year, the market bottoms in September. What can we learn from the charts heading into Tuesday's CPI number? NASDAQ daily trying to make a stand near a logical level. RSI has popped back up nicely. Same concepts here. We're even trying to retake this trend line. Covered this chart last week. This is much better than what we had a week ago, at least from a probability perspective. Somewhat of a mixed bag here. We're holding the trend line, but we're bumping right back up against this area of potential resistance. Here's your mixed bag, somewhat no man's land look. Not surprising to see that heading into CPI. Similar situation here. Nice rally this week, but we haven't retaken this trend line here. A little bit of a no man's land look here. Looks good this week, but work to do. Nice to see this gap being held thus far. This one a little more favorable. All of these as of September 9th. Here's your no man's land look. We recently broke the upward sloping trend line, so this is a bearish breakdown. Now we're rallying, but we really haven't retaken this line yet. We're also bumping up against this downward sloping trend line here heading into next week. We're sitting right on top of the 50-day moving average. There's your tweener, hesitation, no man's land look prior to CPI. Like the Dow, this one looks a little bit better. Broke the trend line. You can make an argument this is a retest, and now we've popped higher above these levels, and we're back above an upward sloping 50-day. Mixed bag here, but a bounce at a logical level. It's possible the look of this chart is going to change, hence the caution here. We'll really have to check on this again tomorrow. But this is a much improved look in terms of the early read after the close on Friday, September 9th. This is last week here. This is this week. Again, word of caution. Chart may look quite a bit different tomorrow. Mega cap stocks, what looks like a bearish breakdown. Now this looks somewhat like a false bearish breakdown back above this gap here. A little bit like the Dow, broad 1500, stand at a very logical level. S&P 500 weekly, often this type of slope matters, still have work to do here, kind of a no man's land look. Good things happening on that 10-minute chart, but no man's land here relative to this trend line. If you pause your video player here, this looks better than anything that we've seen year to date. Once again, this looks better. This is as of the close, end of the week, September 9th. This looks better than anything that we've seen year to date down here. This is momentum. This is an encouraging look too. Here's your no man's land. This is a nice stand here, but there's a lot of potential resistance still up here. Kind of a tweener look. This is an encouraging rollover look. The VIX, these are moving averages. But the question is, are we just coming back to test this line here, and then are we going to move in this direction? Daily VIX looks quite a bit better for the stock market bulls. The longer you stay below these lines, the better. Remember we talked about that waterfall look in 2008 here. This is the S&P 500. Look at what the VIX of VIX did here. Expectations about future volatility in the VIX itself. A big pop higher in this area. That's not what we have in the present day at all. In fact, this is a tepid push back towards this line currently. Obviously, these things can change very, very rapidly. A tweener look here, still below this gap. As of the close on September 9th, big mess here, could still go either way. Right now, it looks relatively constructive. No man's land in here for now. You can pause your video player here, but it's fair to say in its present form, this looks much more like risk on relative to risk off. Still indecisive, but this looks like a bearish breakdown and now a reversal. So this is where the S&P 500 made the original low. Look how much better, much higher this ratio is at this low here. Similar situation here. This looks more like a risk-on look if you examine this chart, above an upward sloping 50-day as of the close. Netflix above an upward sloping 50-day. This looks more like the post-low period over here than the pre-low period over here. In its present form, and that's the key, the chart in front of us, this looks like a risk-on setup rather than a risk-off setup. Came back and tagged the 200-day and now have made a higher high in the ratio. Very similar concepts here. This looks more like risk-on than risk-off. Focus on the slope of the 50-day moving average in blue. Similar situation here, mid-caps in isolation. Focus on that 50-day. This is where the NASDAQ peaks. This is a risk-off look in this ratio. It's a little bit different weighting than the S&P 500. This looks really more like a potentially bullish setup. Ratio hasn't made a lower low in several months. Basically, the identical concepts here. We're trying to make a stand. This is a bullish point in 2016. This is a bullish point at the COVID low. Trying to make a stand here. Somewhat of a tweener look. SH looked like it had a bullish breakout. Now it looks like a failed bullish breakout. But in some respects, if we use closing prices, you can make an argument we're just retesting this area down here. No man's land for the most part heading into CPI. On all these charts, we'll learn something either way. We can't control no man's land looks. You can't have bullish and bearish conviction all the time. When the charts are indecisive, we have to respect that. You can make an argument this leans bullish. Ditto. This didn't look so good a week ago. If it can get up here, that would be more constructive. Still in no man's land, but unequivocally looks better than it did down here. Right in here. This does not look like maximum fear. This is a no man's land look, but the last thing it did here was make a lower low, and this is somewhat of a tepid bounce. Still near an inflection point, but this one leans bullish heading into CPI. Relative to this topic, I think it's fair to say there's a slight bullish bias heading into CPI. It's very, very hard to make a counter-argument when you look at the slope of the 50-day moving averages on these charts. So this is just the 50-day. We've removed price. This is September 9th at approximately 3:45 p.m. in each case. Could we be vulnerable to a reversal? Sure. Look at this here. Look at this here. Look at this here. But right now, these look constructive, and they really don't look anything like the slope of the S&P 500's 50-day in here prior to this waterfall decline in Q4 of 08 into Q1 of 09. Both the breadth thrust and bottoming process cases were on the ropes heading into this week. Are probably still inside the boxing ring. Both are still alive. Here's the average and median drawdown for our 61 data points related to the recent breadth thrust. You can see as of September 2nd, we're moving away. This is diminishing. Bullish probabilities were below the 50-day moving average. September 2nd, an improved but somewhat no man's land look here. We're back in between these two. That's great for the breadth thrust case. The bad news would be we lost this upward sloping trend line and we closed right back on it. What once acted as support, may now act as resistance. This move this week gave us some breathing room, and we have a lot of stick-save looks here. We're well above 3,900. This bullet point doesn't look as bad this week, and this looks a lot better in the short to intermediate term. Doesn't mean everything is great and bullish. It just means we're more evenly balanced relative to this topic here than we were 4 trading sessions ago. So relative to the breadth thrusts, and these figures here being meaningful from a probability perspective, the closer we stay to these lines, the more relevant the prior slide. And the longer we can remain above or in this band here, the more relevant those thrusts become, again, from a probability perspective. These are the drawdowns on cases 41 through 61, and these are the cases with the highest drawdowns. So from a historical perspective, we didn't overshoot this band. In fact, we made a stand above the average and median level based on these cases. That's the case for now. It doesn't mean it's going to hold. We covered this chart last week. You can find the commentary. How does it look this week? We bounced at a very, very logical level. Covered this last week. You can find it in last week's video. Once again, we bounced at a logical level. We've still got the competing themes. A lot of tables with a lot of green. And last week, we had 2 tables with a concerning amount of red from a frequency and magnitude perspective. This is the example we used quite a while ago relative to our models. This look in here was concerning. In the present day, this is emblematic of what we're seeing in the models. We were hoping that some of the longer-term data would continue to improve. It has. This aligns with that tweener look. If we continue to move in this direction, we have a lot of scores in the market model that should pick up steam. It's very, very possible that this is going to roll over and look more like this. But there's no question the math looks better today than it did in here. And if that continues to be the case, even if we fall, then 3,900 won't be as important. We could give our positions a little bit more rope down here, but we'll just have to see how it unfolds. A lot of stands made this week near logical levels. It's not necessarily bullish. We're still somewhat in no man's land with the competing themes, with possibly a slight bullish bias heading into CPI. Longer term, the bullish case is based on these major assumptions. We're not currently in a recession. Inflation will begin to fall in a material manner relatively soon. The Fed's rate hikes will not cause a recession, thus allowing for the favorable seasonals to push stocks higher into year-end and into Q1 of next year. It's also important that we understand and respect the bearish case. It's primarily based on inflation remaining persistently high. We should get more information on that front this week. Under that scenario, the Fed's most likely forced to hike higher and hold rates higher for a longer period of time. That would not be particularly good for corporate earnings, incomes, and most likely the unemployment rate would go up. This and this are both heavy weights relative to that recession question. And thus, if this is true, it wouldn't be shocking if we entered a recession sometime in the next 6 to 9 months, even though we're probably not currently in a recession. And if that's the case, then we have to respect that the S&P 500 from a historical perspective and from a valuation perspective could fall all the way to 3,000 or maybe back just to 3,400-ish. We have had and still have contingency plans, not making any assumptions about any topic going forward. Assumptions create bias, lack of flexibility, and they bring your ego into the equation. We've been running and will continue to run, which is basically what the model calls for, a database thrust and trend allocation strategy. We take the thrusts into account and we take the trends into account. As of the close on Friday, we're in a really, really good spot relative to no man's land and the data that we have in hand. It's very important to respect that these are rare circumstances. And this is a little odd here. Markets are always highly complex, but even more so in the present day. Have to remember the lessons from the 1970s relative to inflation and the Fed, and we have to respect both downside and upside risks. And that speaks to maintaining a prudent allocation. And as always, we all know, none of this is going to work properly unless we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.